Alarm bells ring in October as stock and property markets wobble globally. All this and more in this video update. Hi, I'm Mark O'Byrne, the Research Director of GoldCore.com, your precious metals specialist. And in this update, we're going to look at what's happened in markets in October. It's been quite an interesting month, very volatile, a lot of turbulence in markets. And I think many of the things that we've been talking about in recent weeks and recent months seem to be at last impacting the markets. You know, many of the financial, economic, and the political risks that have been bubbling away under the surface of this financial volcano that we have in front of us, they've come to the fore, and definitely we've seen a bout of risk aversion that we haven't seen in a year or 2 years, you know. So it's been very, very interesting, and we think it portends what we're going to see, maybe not in the rest of 2018, but I think in 2019, we think we're going to see similar market conditions. So, yeah, bottom line is, as financial markets fell internationally and risk aversion came into markets, stocks came off as would be expected quite significantly, and gold prices rose, and gold prices have again acted as a safe haven, as a hedge, exactly when investors need a hedge. You know, there's been a lot of talk about gold isn't acting as a safe haven, but investors haven't needed a safe haven because risk assets, in particular stocks and bonds, have been going higher and higher and higher, you know. So, but these risks, as I said, they're sort of bubbling away underneath the surface, and they've been largely ignored by the media and many of the experts, and people aren't joining the dots and looking at this big picture, sort of the context behind what's happening in markets, you know, and I said not joining the dots, and I think slowly but surely some people are beginning to join the dots, and some of the market participants are beginning to join the dots. So let's just get into, I'm going to share my screen here and just look at, we frequently feature finviz.com tables in our market updates, and because they're excellent, and I'm surprised more people don't use them, but they're a great sort of snapshot. You can get your snapshot. You can see up here. You can get your daily, your weekly, your monthly, your month to date, your quarter, your half year, your year, and year to date. So you get a really good feel what's happening in markets, and you can see month to date relative performance. So we're now the end of October and the start of November, and as you can see, gold is up just nearly 2%, so 1.9% in the month to date. The VIX, which is another interesting measure of volatility in markets and risk aversion, has absolutely surged 46%. And then the leading benchmark indices, stock market indices, are down very, very significantly indeed. So Euro Stoxx 50 is down 6%. See that in here. The leading, the DAX in Germany, down 6.7%. The leading US benchmark indices, S&P 500, is down 7.4%. Again, that's just in 1 month of October. The Nikkei in Japan is down 10%, and the NASDAQ tech stocks is down 10%. So, you know, and this is just literally in the 1 month period. If you actually look from peak to trough, so their recent record high prices to trough, some of these stocks are down by a lot more. China is down by 30%. The MSCI Asia Pacific Index, which is a proxy for Asian shares in general, has actually entered a bear market. It's down over 20%. The Australian ASX is down 15%. The Nikkei, I think, from the peak to trough is down 15%, and looks like it's on the verge of a bear market. The S&P 500 is down 10%, so it's in correction territory. And so the question now becomes whether this is a correction or the start of a larger bear market in stocks. So yeah, they're very sharp corrections indeed, and yeah, it's primarily in the tech sector, but it's not solely the tech sector. It's also being seen in financials, banks, brokerages, financial institutions, lenders. There's a lot of weakness have crept into that sector. There was an excellent chart from Zero Hedge yesterday, which shows that the FANG stocks are down 23%. So the FANG stocks is your Facebook, your Amazon, your Netflix, and your Google. So that's quite a sharp. They're in their own little form of bear market there. Facebook is down 34%, Amazon 23%, Netflix 33%, Google down 18%. So they do look very vulnerable indeed, because they are, as we've been talking about for a few weeks and months, they look very, very overvalued indeed, very toppy. And I think, yeah, there are parallels with the 1999 tech bubble in terms of the overextended valuations. So yeah, it's interesting, and it's also coming at a time that we're seeing property markets globally. Some of the big international cities that have seen massive gains and price appreciation in property markets globally, they are seeing some weakness creep in, particularly in Australia, in Canada, and in London, which is one that we've looked at for a long period of time, because we felt that it was particularly overvalued, and we thought, because of overvaluation, when interest rates went higher, the property price would come under pressure, but also because of Brexit. So we'll just look at one or two. In a very interesting article, we actually covered this feature in the news, in our GoldCore news last week, the daily news we do. This is from Deloitte. House prices are falling by over $1,000 a week in Sydney and Melbourne. So that's, 50,000 a year, it doesn't take a genius to figure it out. So you're seeing quite a sharp depreciation in property in two leading cities in Australia. It's not just Melbourne and Sydney, it's also Perth and Canberra, and other cities are seeing weakness. Gravity has caught up with that stupidity of rapid house price growth, according to Deloitte. So, yeah, you can see there's just more risk aversion, basically, and the happy clappy narrative of perpetual economic growth and never ending price appreciation in house prices is coming to an end, and people are realizing that prices fall as well as rise, and recent performance is no guarantee of future returns. And so it's not just in Australia, as I said, it's in Canada, and the other big market that we keep an eye on is the UK and London, and asking prices in London have been slashed by 26,000, according to this article in the UK Independent. So it's not just London now. We've been looking at the weakness in London for a long number of months, but it has spread to other parts of the UK, particularly the south of England. And yeah, it's again indicative of I think a trend change, and also just a change in psychology, because all these markets are ultimately driven by psychology, and there's been a lot of irrational exuberance, as Alan Greenspan would say, both in stock markets and in property markets. So that's beginning to change, and these are just a sample of, there's dozens of articles online showing this, but no one's sort of joining the dots and sort of figuring out, well, what are the ramifications of this, and I think it ultimately will impact the consumer and consumer sentiment, and then it will impact the high street and retailers, and then businesses sell their goods and services. So it has all these things have knock-on effects and ramifications for the wider markets and indeed the wider economy. Then our own little city here of Dublin. Its weaknesses come into the marketplace. We covered it last week, actually. The FT did an article basically looking at the possibility of, let's see, no, that's not working there. Refresh. No, let's ignore that one. So basically, we covered in the market update last week as a Financial Times article that basically said, asked the question, is Dublin in the housing bubble, and will that housing bubble burst again? And they looked at myhome.ie study that showed that 68% of properties in Dublin 4 and Dublin 6, so the high end of the Dublin property market, have actually reduced prices in the last few months, And now, only today, 18 hours ago, we see Knight Frank have a report, the international real estate agent, talking about the cost of Dublin luxury homes falling for the first time since the recovery. So they're down by 1.7% in the year to September, and they're actually down by 2.7% in the 6 months to the end of September. So yeah, that weakness is creeping in at the top end of the marketplace, and I think it's only a matter of time before it percolates into the rest of the marketplace, given the big global risks that are out there. So, and what are those risks? We cover them here quite frequently. Obviously, there's the trade wars with Trump and deepening tensions with China. There's the geopolitical risks in terms of tensions between the West and Russia. and how that may manifest, and indeed trade wars with Russia and economic war and sanctions with Russia. And then there's the risk from Italy is another one that we've looked at in terms of the political crisis there with the rise of the populist parties and the right and the left, and the huge debt crisis that they're facing in that country, and now the tussle they have the European Union, and then of course there's Brexit as well. So, but the bottom line, and different investors in different countries are facing different sets of risks, but there's a lot of sort of big global financial, economic and geopolitical risks that are there, and as I said, have been largely ignored up until this month. So it's interesting, and we do think it's a trend that's going to continue, and I suppose the risks, they are very real, and it's only a matter of time before they impact risk assets as they have been doing. So there's one last article I want to share with you, which is our friend Mark DeCambra in MarketWatch, Dow Jones MarketWatch. I know Mark, and I've had a conversation on many occasions. He covers the gold market and the wider markets for MarketWatch, and it was actually our colleague David Russell who spotted this article last week and sent it on to me. It's an excellent article, and he was looking at basically why have markets tumbled recently, and what are the reasons that investors are worried, and it's well worth a read. But he actually lists the many reasons for worry today, and MarketWatch are quite good at looking at these various risks, and they have looked at these risks. And he went down through. I'm not going to read through the whole list of risks here, but they are very, very real, and there's a whole host of them there, and I think, as I said, they are now different investors have different concerns about different things, obviously, but these are very, very real risks, and the bottom line is economic growth is slowing down internationally, and we see that in some of the latest data that's come out. The US data is actually showing a slowdown in the US housing market, US car markets. There's a lot of sort of big picture fundamental indicators that suggest that weakness is creeping in. The Chinese economy, the US economy, the major drivers of growth, and then obviously the global economy, and I think that's obviously the primary risk. But behind that is something that we look at quite frequently, which is the global debt bubble, and the fact that debt globally has increased nearly parabolically in recent years, despite the so-called recovery, and debt globally is well over the 300% debt to GDP ratio, which is quite a critical ratio. So we think that economies are much more vulnerable than people realize, and this creates a real risk of another global financial crisis. So yeah, it's. I think it's a time. October, I think, is giving people a warning signal. The alarm bells have rang, and it's time for people to wake up. And don't panic. Just the usual investment advice is it's a good time to rebalance your portfolio. Most people, investors, would be over allocated to stocks and bonds, and some investors may have significant exposures to property markets. So it's a good time to reduce exposure to these assets, particularly risk assets, and to diversify into gold, which looks particularly undervalued at these levels. And I think you will be rewarded handsomely if you do that in 2019 and indeed in the coming years, because these risks are, very, very significant indeed, and it's only a matter of time before they do impact financial markets in an even more significant way than we've seen in October. So diversify, rebalance portfolios, own safe haven gold, and talk to us. That's what we specialize in. We allow people to own gold in the safest ways possible, including with what we've just launched recently, our direct access gold program, which we believe is one of the safest ways to own gold in the marketplace, if not the safest. And it's an evolution of our GoldCore secure storage service, which was already one of the safest ways in the world to own gold. And now we've gone to the nth degree in terms of building in further protections for our clients and for our investors. So thanks for your time. Stay safe. Look after yourselves. Take care. Bye-bye.